What's going on, guys? It's Andy here. Welcome back to another episode of Painfully Honest Advice. So hey, I'm selling my stocks. I'm going to share with you guys why I'm selling some of these stocks within my portfolio and what my plan is going to be going into next year. Now here's the thing, the Dow Jones has officially hit over 30,000 and we are hitting all-time highs. I do believe that there's a correction coming because hey, the party does have to end eventually. So I'm gonna go ahead and share with you guys my strategy going into next year. Plus, I'll go ahead and share with you guys my portfolio and all the stocks that I am actually gonna be selling. Now the S&P 500 is also trading over 20 PE ratio. Basically what that means is all these stocks are totally overvalued if you go ahead and look at these companies and what they're trading at based on their earnings. Now, I do believe that there is going to be a big market correction that's going to go ahead and adjust the market by at least 10 to 20%, which is coming. And with all these growth stocks like Tesla's, like Shopify, some of these stocks that are totally overvalued are going to go ahead and have a correction. Now, here's the thing. If you are going into investing and you are basically going to go ahead and start a portfolio in 2021, my biggest piece of advice is going to be to go ahead and dollar cost average into the stock market, because if there's a correction coming, you can go ahead and take advantage of that. Now, the reason why I'm selling a lot of these stocks within my portfolio is because I am changing my strategy around a little bit as far as focusing on certain sectors. So I'm going to go ahead and share with you guys some of the stocks that I basically eliminated or trimmed down on. Plus, guys, all of these stocks within my portfolio do focus on primarily dividend growth. Now, I started this portfolio in the last 1 year, and basically within this portfolio, I started with stocks that were paying me out higher dividends. But these were riskier stocks because they didn't have the potential to grow, and hence companies like Chevron or companies like ExxonMobil, AT&T's, Philip Morris, Altria Group, all these companies pay between a 5 to 7% dividend. But these companies don't actually have a lot of potential to go ahead and actually grow as far as the stock price goes. So throughout the year, I went ahead and trimmed down some of those positions, but I primarily started focusing on dividend growth stocks because I'm not looking to basically retire for at least the next 20 years, and I do want to see some growth in the portfolio while I still get some dividends. Now, additionally, guys, if you are invested in the stock market, and because we're near year's end, the other reason why I'm selling out of some of these stocks is going to be because I have some profits within the stock market and with the dividends. I have roughly around $1,000 in just dividends that I've gained in this portfolio in this last year. Now, in regards to the dividends, you do have to pay taxes. And in reference to taxes, here's a way, and this is a quick way that you can actually eliminate some of those taxes and not pay taxes on your profits. Is if you have stocks that you've actually lost money on within the portfolio, you can actually go ahead and sell those stocks at a loss, and any profits that you had in the stock market, you can actually go ahead and offset that. That's part of the reasons why I actually trimmed down on some of these positions that I was actually losing money on, because I don't want to pay taxes on the gains that I've had in this portfolio. So by going ahead and eliminating stocks that I actually don't believe in anymore, or that I just wanted to go ahead and trim my position on that I was taking a loss in, I'm able to go ahead and offset those gains. So these are some of the reasons why I've actually trimmed down on the positions and why I'm selling some stocks. And as we get into next year, I'm reevaluating all my goals. And next year, I am going to focus on dividend growth stocks, but I'm also going to focus on a little bit of growth as well. I have added positions within my portfolio, so I will be making a video in regards to revealing my full portfolio and the full changes that I've made in reference to dividend stocks and dividend growth stocks, plus the growth stocks that I've added. Now, let's go ahead and jump on the computer. I want to go ahead and share with you guys some of the stocks that I've actually eliminated. And overall, guys, I've actually eliminated 10 positions within this portfolio. I'll share with you guys why in reference to all of these stocks that I did go ahead and trim down or sell out of the portfolio. So I am in my M1 Finance portfolio. Now, in reference to this portfolio, I do dollar cost average in this portfolio. I call it my bucket list portfolio because I'm looking to hold on to it for a very long time here. Now, I have this portfolio broken up into the 11 different sectors within the S&P 500. Plus, I do have a pie that's my growth pie as well. So these are the different sectors that I have in this portfolio. But guys, here's the thing. The 10 stocks that I got rid of, I'm just going to go ahead and run through those one at a time and share with you guys why I actually got rid of that stock. But the first one is going to be CCI, which is Crown Castle International. Now, in regards to Crown Castle International, I sold out of my full position. I had roughly $800 in value in the stock. My share price was $164, and I had roughly under 5 shares. But Crown Castle International is considered a real estate investment investment trust. And in regards to this company, I do like this company overall, but when I looked at the growth within the REITs, I do believe in other REITs that have a higher potential to go ahead and grow. Now, Crown Castle is certainly not a bad company, but when I look at their overall 5-year growth, this company grew by 81%, and I'm honestly looking for higher growth. So because the stock did not fit, and I believe other stocks do, that's why I eliminated the stock out of the portfolio. Now, the next stock that I actually got rid of as well is APD, or Air Products and Chemicals. Now, this is a stock that I had within my materials sector. But again, another stock that's not growing as much as I was actually expecting the stock to grow. As far as the 1-year returns go, it's growing at an average of 15%, or it grew by an average of 15%, I should say, over the last 1 year. But additionally, other stocks within this sector are growing by a lot more. But now if we go ahead and look at the stock, I had about $607 invested in the stock, so not that much, because the material sector I don't invest in heavily because that sector just doesn't have a huge potential to go ahead and grow. But I had about 2 shares, so not that much in the stock. And guys, the third stock here is going to be Dominion Energy. Now, Dominion Energy sold off a huge part of its investment portfolio to Berkshire Hathaway. But in reference to the stock, this is a stock that I had within my utility sector. And again, I don't see the growth potential in the stock that I see in other stocks within the utility sector. Personally, I do like NextEra Energy. That's probably my favorite stock within the utility sector. But in the stock, I had $770 in total value, and I had about 10 shares. But if we go ahead and look at Dominion Energy in the last 1 year is actually down about 7%. And overall, in the last 5 years, the stock has grown by 12%. So that's not a lot of growth. Now, as we get into a little bit larger dollar amount, the fourth stock that I actually sold out of this portfolio is Lowe's. Now, here's the thing. Lowe's is a great company, and honestly, I had a very tough time selling out of this stock because I do have Lowe's and Home Depot. And basically, both of these companies are exactly the same when you look at their stock price as far as the growth of these stocks. If one stock goes up, the other one basically follows. So I am a bigger believer in Home Depot as opposed to Lowe's. So I did keep my position in Home Depot, and I did go ahead and grow my position in Home Depot. So in regards to Lowe's, I had $1,265 in total value, or roughly around 8 shares that I did sell out of. Now, if we do look at Lowe's, yes, they do overall have great gains. In the last 1 year, they've gained about 36%, but I also believe that was due to the pandemic. With the pandemic, a lot of people were actually doing a lot more home improvements. But now if we go ahead and jump into the next stock that I did get rid of was within my financial sector, and that's Rowe Price. Now here's the thing, I was just overweight in the financial sector. So this is another company that I did go ahead and get rid of because I wanted to go ahead and trim my position within the financial sector. So if we go ahead and look at Rowe Price within my portfolio, I had a value of $1,355 and my average share price was $147. So I did go ahead and trim my position in this stock. But now if we go ahead and look at the next stock that I actually eliminated as well, I got rid of Verizon. Now Verizon is a company that I had within my communications sector. But because I didn't see the growth potential that I see in other stocks within communications like Disney, like AT&T, and even T-Mobile, I believe that Verizon will grow, but it won't grow as much as some of those other companies. So I did trim my position in this company as well, again, focusing on more growth within the portfolio. So Verizon, I had a current value of $1,836, and I had about 30 shares of this company, and the share price was $60.11. Now Verizon is currently trading at $60.46, but overall in the last 1 year, the stock has just been trading sideways. So this stock is down actually a little less than 1% or 0.66%. So another stock that I actually eliminated out of the portfolio. And now guys, this next stock, unfortunately, was a stock that I had a very tough time selling as well because this is in the REIT sector, but this is going to be Prologis. I'm trimming down within my REITs, and basically I believe in stored capital a little more than Prologis because I see when the economy is going to be turning around and small businesses are coming back. And as being a small business owner, I believe that triple net leases and companies like Stored Capital have a better valuation, and these companies will go ahead and grow even quicker. So I eliminated my position in Prologis, and also because I don't follow Prologis on a day-to-day basis, this is a company that I just don't follow, so I actually eliminated my position fully in the stock. So Prologis, I did have a smaller position in the stock, which had a value value of $782. So I did go ahead and eliminate the stock. Overall, in the last 1 year, the stock was up 12%. So not bad overall in the last 1 year, even after the pandemic. But just the focus has changed on higher growth potential stocks that I am investing in within this portfolio. But now the next stock is going to be Accenture. Basically with Accenture, I wanted to go ahead and just trim down on this position. This is a stock that I still own, but within my technology sector, I went ahead and sold off some of the stock so I can actually reinvest some of that money into Apple. So overall, I sold $1,189 in the stock, and the share price that I sold at was $244.91. But if we look at Accenture, I mean, this company is still growing. They're up 29.4%. So I do believe that this company has a high growth potential. But when I compare this to Apple, I'm a huge believer in Apple, and I do believe that company is going to grow even quicker than this one. So this was another stock that I actually trimmed my position in. And then guys, I actually eliminated my position in Pepsi. Now here's the thing, Pepsi is another great company. Honestly, it's an awesome company. I've actually started my portfolio with the stock and bought the stock within the first week when I actually opened my portfolio. But here's the thing, Pepsi's growth potential is, in my opinion, not as high as some of the other stocks. Because I'm looking to hold on to this portfolio for a long period of time, I am going to focus more on other growth stocks. So I did eliminate my position in Pepsi. I had a value of about $1,121 in the stock. And if we look at the last 1 year, the stock has grown by 8%. But as I went ahead and changed my strategy into more of the growth stocks and more on dividend growth stocks, this is a stock that I actually decided to go ahead and eliminate. So these are going to be all the different stocks that I actually trimmed down on or totally eliminated from this portfolio. Now I am planning to go ahead and make a video in regards to all the stocks that I actually purchased and all the new stocks within this portfolio. As we get into 2021, I went ahead and actually reevaluated my full portfolio and my investing strategy as we get into next year. And this is a great time, guys, to go ahead and trim down on any of those positions that you might be losing money on. But I'm going to go ahead and leave it at that for this video. Now I do invest with a couple different apps. I do have a couple links down in the description if you guys are interested in checking out M1 Finance. This is basically where I have my bucket list portfolio. Plus, guys, if you want to take advantage of some free stocks, this video is being sponsored by Webull. Webull is basically one of the best platforms out there that offers the best perks. So I highly recommend to check it out because at the end of the day, it is free money and you do get 4 free stocks just for signing up and depositing at least $100 in your account. But thank you guys for watching this video. If you are new to this channel and you like this type of content, go ahead and subscribe to the channel down below. And don't forget to smash that like button as it really helps the channel out. But thanks again, guys. I'll see you guys at the next one.